misfits of real estate. I've got my friend Mark on the phone right now. And without any further ado, we'll just jump right into it. So, Mark, we usually just start by having you give the audience a little bit of your background, how you got started, and where you're at today.
Yeah. So I guess I'm in the real estate niche now. Was kind of my story on getting here a little bit is more or less I was a concrete guy by heart. I was since 6 years old. I worked next to my dad all the way through. My parents divorced at an early age. And from the age 6 all the way to the age of 20, basically through high school and college, basically worked concrete construction within my dad's company. So that was legal.
Nice.
And when butt heads with dad, just vision on the company and where he wanted to take it. Kind of just we saw differently. We'll just put it that way. And I went to get a W-2 job. I actually um, yeah, got fired from that job a year into it. Bought a house though, had some bills, met my wife. So I needed to do something. So I resorted back to construction, even though I had some college degrees and different things. And my dad always told me, he's like, you probably should get a college degree so you don't have to do, pour concrete the rest of your life. And that made a lot of
Right.
sense to me. But I also had a passion for it, and obviously I was very good at it. So I just on a whim went back into construction. I called it MAK, M-A-K. And, we've the first 7 years of my company, 6, 7 years, I basically just was an egotistical concrete guy, not asking for help. And just kind of built the company, 1 or 2 people every year. Well, by the time year 7, 6, 7 hits, you're starting to accumulate a lot of people and a lot different problems, people problems, trying to figure out actually how to operate a business. And by doing all that, I actually wound up in the hospital, which was like my aha moment of I had anxiety, panic attacks. Like I was I was a broken entrepreneur, basically. I didn't have a business. I just had a bunch of people who worked for me and listened to what I told them to do. So, and so while I had that doctor visit, that I was in the hospital, literally hooked up to all these EKG monitors and whatever, it's like I kind of had a reflection point. It's like, yeah, I don't have a business. I can't leave for a month. I started getting curious. I just started like, hey, what does it mean to have a business? Like, oh, can you walk away for a month and your business will still be operating and producing cash flow? It's like, no,
Mhm.
it'll stop tomorrow. So, and then also it's like, what do the really wealthy do to keep building themselves and like, between buying pickups and equipment and all this construction stuff, how do you actually buy assets and things that actually appreciate in value, but also depreciate on paper,
Right.
aka saving money on taxes? So a little guy named Grant Cardone is the one that popped up on my phone and he was educating the hardest in 2018 there. And that's where my curiosity began through the real estate journey. So kind of bringing me up into what I do today.
That's so cool. We have a lot
Yeah.
of similarities. I also worked for my old man, butted heads.
Okay.
That didn't
Yeah.
work out very well.
Yeah.
I didn't last more than a month, and I didn't charge him either. I was like, "Don't even pay me." Like, but we ended up being partners on the real estate side, so I think it was probably for the
Oh,
better. And
that's
then, so
awesome.
here's the real question: can your father walk away from his business for a month and have it be fine?
Now, so my dad built a business of like, let's say top of the line, maybe 5, 6, 7 people. Like,
Hmm.
it was always basically him running it. But then at the end of his career, where I wanted to start stepping in and help keep growing, he wanted to shrink it down. And so every year he just kind of used his name and shrunk down the business to be as efficient as possible to make
Hmm.
the best bottom line revenue.
Yeah.
Deleting all the full-time workers, just hiring part-time. And so, and then all of a sudden the company, of course, if you're not growing, you're dying. And it just died. He cashed out on it just by soaking it all the way down to its very nitty gritty.
Hmm. So,
So
how many employees did you have at your peak, and then do you still have any of those employees today?
yeah. So now that I'm in Mac construction, and I was able to gain, so like I said, I've had a couple of employees. This is our 13th year in the construction side of things. This is
Hmm.
like the sixth, 7th year in the development game. And within that, and we're up to 50 plus people now and continuing to
Wow.
grow, and
Yeah.
continuing to grow. We have a concrete company, we have a holding company that has civil contracting and concrete construction, also general construction and development. So you start getting all these verticals integration, and
Hmm.
that's where business starts to get a little more fun. And that's kind of what I'm evolving into right now. just as we continue to grow.
That's so cool.
Yeah.
So I'm really curious how you structure it all because I only have maybe like 15 people on payroll, but I try to
Okay.
get into the construction and into the development side of things as well. I don't have 50 people. And I know I speak with a lot of developers that keep their payroll very, very small. I mean,
Yeah.
almost like no one on their payroll, maybe like one person. And so it's really interesting to hear from you that you're doing basically what I think I should be doing, which is, having these vertical integrations in my company.
Yeah. Like I was just the contractor. I was just getting hired by the developers, and I just was like, how do I get to be that, right? Like that's your
Mhm.
curiosity is stemming. And I think the only way you can get there, you got to figure out how to raise money. You got to figure out how to gain investor trust, how to actually develop a project, and how that gets monetized as a whole. I think as a
Mhm.
development company, though, yeah, you're right. It's not like you just charge big fees and you get these fees. Everything's dumped back into equity. So most
Yeah.
developers are cash poor. The ones that are probably doing it right are cash poor. Not saying that you want to be cash poor. It just ends up being what happens.
Mhm.
So kind of by that nature, you as a developer, all your money is going right back into equity and unlocking, hopefully unlocking future potential equity that you're going to have, I guess.
Yeah.
Building your net worth. So it's not a great way to monetize by any means, but if
So
it can
you've
work with the
developed,
rest of your companies, then it works, right?
yeah, and you've developed your own deals. And now, were those deals that you've raised money for as well, where you've got other investors, or just like strictly your own deal?
Yep. So then Mac Capital came about, and that's really my money raising machine. And that's
Mhm.
me educating other investors as well as bringing in new investors that just want to invest as LPs. So through that, I've done syndications through Mac Capital and raise money through that. And I just like to invest in the boring stuff. So the people that are attracted to that are end up being some of the LP investors that like it. So I think the boring stuff makes the most money, kind of my Cody Sanchez ripoff for real estate, but it's definitely true. So we do things like storage and Class B multifamily. Not too many shiny things for us.
Yeah, still multifamily is pretty intense from a
Yeah.
development perspective.
Yep.
So, are you the KP as well? And then, what is it like going to the bank and being like, "Hey, I raised all this money. I'm the KP. I'm also the developer. I'm also the general contractor." Was that like you had to build a little bit of a track record with the bank, or were they okay with it? And how do they feel about the way that you have it structured as far as the fees go from the general contracting side and then also from the development side?
Yeah, so I'm up in North Dakota. It's definitely an educational standpoint, even for the banks, because they're not seeing this a ton of developers raising money like that.
Mhm. Yeah.
For me and my developments, I end up funding, guaranteeing the loan, getting the projects almost like to the point where they're like 50% built. And
Okay.
then I put things together for the LPs. So all the guarantees, I'm not waiting on their money on to start it. I'm bringing the equity, and then I have all these verticals that I'm contributing fees to make the thing roll right out of the gate. And then at the 50% point, that's when I go get 506B or C paperwork and actually try to raise some money, get some capital to pull some of my equity back out and go do another project that investors would, my investor base would like
Mhm.
doing. But yeah, you definitely have to have a track record and credibility. I'm still building that today, right? Like we're always building that. Today is the hardest time, some of the hardest times ever to raise money. You got all these syndications going sideways. A lot of people just charging astronomical fees in 2001 and 2. There's a lot of investors that are pretty tight right now, and skeptical on whether is the economy coming back. Are we going into recession? Just a lot of uncertainty. But I also feel and I tell my LPs that, hey, you know, no one's developing right now. Not I shouldn't say no one. Very minimal are developing because the banks are tight. You can't get the lending. And investors aren't willing to give up capital easily, and there's capital on the sidelines, but it's still on the sidelines. It's not
Yeah.
being dumped in these projects because of purely a yield standpoint. Yield on cost is how we view it as developers. And they're finding more yield just sitting in a bank account right now or a high yield savings. And it'll flip though. If they start talking interest rate cuts, the first thing that's going to go away is those high yield savings accounts. And you'll start seeing a flood into stocks or real estate. Is the way I believe it. But we are still developing through this, which I think is key. I think
Mhm.
you need to be developing always. I think we're still behind in where
Oh,
we
yeah.
should be developed to. And everyone that, our deals may look thin right now or very little cash on cash return, but we're hitting our DSCR and we're making things work. And we think that if we can underwrite in today's terms and develop in today's terms, we do think it gets better in the future.
Yeah.
So
Where are you at as far as your loan to value? If you got like a 1.2?
yeah, in storage, very debt heavy investment there, class. So you're at the 65. We've hit one smaller ones in the $2 to $3 million, at like a 70/30. But if you're
Mhm.
doing a big, couple 100,000 square foot facility or something that is pretty decent sized, you're going to be at 65 or probably even less right now. So
Yeah. Okay.
um, yeah.
So how the bank is going to require you to have your equity in first, and if you're doing the project after you've already halfway through it, that means you're funding the first half of the project yourself.
Correct. Yeah. Yeah. We
Yeah.
actually make sure we have all the funds locked in. So, today as a developer, I had a long conversation this morning with a couple other big developers, that do 50, $60 million deals. And, they got the landowners contributing, they got subcontractors contributing, they got, a lot of investors on the sidelines will say, they'll do more of a debt investment. So they'll give you short-term money for at 8% or something. They're getting very creative though with how they're getting their deals done. They are getting them done and they are bullish on 2025 interest rates when these projects are actually developed and stabilized, and times when you're going to actually refinance out of these and really get your uptick as a developer.
Yeah.
Yeah. So that's what I'm seeing. A lot of launch contribution of land. To get a chunk of land 2 years ago was almost impossible. Like it was like
Mhm.
wildfire. It was trading hands so fast, and then now it's like all those seeds we planted and couldn't come to agreement on price. Now we're starting to get those calls back. So and then they're in the deal with us, and sometimes they bring a majority of the equity within the land. So um, that's kind of a approach that we've been taking lately. Yeah, I think you have to be in creative in times like these. Is
Yeah.
just what we're finding out. So
So are
yeah.
you then just you'll leave your profit in the deal and keep that as your equity later, or are you leaving more than just your profit, or how are you structuring that as far as building your own portfolio?
Yeah, right now, like I said, I'm a younger generation developer. I'm very invested in every deal we have going on. I think it just shows good faith with the investors that even when I'm building these deals and I bring them in at the halfway point, that it's already funded. I'm already guaranteeing it. I'm bringing you guys in as a way to take my position down to go do it again. So, um, yeah, I don't know if that answers your question, but I mean, yeah, I'm invested in every deal,
Mhm.
and yeah, I don't think developers live with a huge bank account that just sits there, right? Like we're
Right.
continually getting ways to reinvest it and reinvest it, reinvest it.
Yeah.
You don't want to get caught, right? So you gotta, whatever you think your cash position needs to be. Like I treat my companies just like my real estate, right? Like 6 months reserves. You can go back to the Dave Ramsey methods, right? Like just what you should have on the sidelines in case things do go a little south. But if you're underwriting today's terms, I do believe that in the future you will have a good project in a couple of years that you'll be able to refi and have a nice cash flowing project. So
Yeah. Do you separate your development and your construction from like a entity perspective? Like, are they both incorporated, or do you just have them under one corporation?
yeah, great question. No, and I have Mac Capital, Mac Construction, and I've kept it separated just because Mac Capital is my money raising. It's also my development tool,
Okay.
um, and it just doesn't blend very well with just construction. Construction is just very much a management company
Hmm.
and an operation. So we try to spread. We use them as a tool to our advantage to hopefully build at a cheaper cost than a competitor, but they're also not developers. It's a whole nother. They work closely hand in hand, but they are separated. And I think if you're going to get some fees raising money, that's just a way you really don't have a big way to. You can't charge big fees in development. You can charge some fees as a syndicator, but it's got a pencil too, right?
Hmm.
So
Right.
a lot of times you can get 50% of the development fee or acquisition fee, whatever you want to call it, and then maybe get paid $5,000 a month till it runs out or something. We've seen that quite a bit. So that's kind of a couple ways that I've seen it. But yeah, I just keep them separated. It's just
Yeah.
cleaner.
And then is there any problem mixing the capital raising with the development side? And what does your payroll on the development side look like? Is that super light? And then most of your payroll is over on construction?
Yeah, you got it. Yep. So there's very light on development.
Hmm.
If you're a developer working for me, you're fighting for an equity position within the project. That's a lot of times an alignment tool in the development side because, as we said before, there's not a ways to a lot of monetize development people,
Hmm.
unless you're doing the property management. Again, all the verticals, the construction, the property management, whatever it is.
Hmm.
There's no way to monetize a development people without making them make sure to align their interest with buying an equity into the deal, right? That's their
Yeah.
goal to get it to the finish line because it's gritty. It is. It's a gritty sport that we play, and um, it's really gritty right now. So got to get
You've
things
built
to the
out,
finish line.
right? And you've built out the management side in addition to everything else that you're doing.
Yeah, so property management. So it's actually it's kind of a failure, but a good thing. So we used to manage all our multifamily units and try to keep everything in house. Just it felt a good alignment tool with the investors again, right? Like it's like,
Mhm.
oh, everyone does property management. Well, I had my wife actually open up that company and she operated it. But geez, man, between there was some turnover there. It's a difficult unless you have 1,000 units at the bare minimum. There's just not
Mhm.
enough income. You're break even if not losing money, even charging a 5, 6, 7%, whatever you can get in your
Mhm.
market. Very difficult. So we actually outsourced the property management to someone who would invest in our projects as well as align with us.
Gotcha.
And then we just got really good at asset management for our investor side. So because we were spending too much time in the property management, it's not what produced the revenue for
Right.
us.
Yeah.
We rather give it to a company that has 2,000 units and better processes in place than us than learning all them. So it was a difficult year and a half. I did learn a lot. I'm not saying
Mhm.
you shouldn't do it. I'm just saying it's difficult from the 0 to 500 phase is difficult.
Yeah. I like that you threw that number out there, about 1,000 units. So if you're collecting 4 to 6%, you need about 1,000 units in order to be profitable.
Yeah.
We charge 10%. We
Oh, well.
manage a variety of smaller stuff, anything from a single family up to, maybe like a 20 unit,
Okay.
but not much big stuff. And, for that, we charge a premium because we got to drive around to a bunch of different locations, and it's just
Right.
not feasible to lower the rate. And I tell everybody that's looking to get into that model that, it's probably 250 units that you need to just
Okay.
be able to hire somebody and have them full time on staff and not have to do the job yourself, right? And
Right.
so there is a barrier entry on the smaller side as well.
Well, there's a learning of all the properties too, right? Like, even if you lose the property manager that you had for 100 homes, it's like now you gotta have this new property manager discover the 100 homes and all their quirks and things, so
Mhm.
it is definitely difficult, and I know people don't like to pay the 10% or whatever the fee is, but, even in the big guys, they're, like, going down to 2.5 to 3%, these
It's
guys with
crazy.
3, 4, 5,000 units. Again, there's management on site though, so they're just
Yeah.
managing the financials and communications. So it is
Mhm.
different.
It's a little
But
different. Yeah.
I mean, man, property management's a tough game if you're going to you're not gonna get wealthy in it, but you will get the first crack at maybe a home that sells or an investment
Mhm.
deal that sells, and that's the real upside. And it's a great I mean, it's a reoccurring revenue type, you know, business.
Yeah.
So I do like that about it, but I
Yeah.
just
You're
I couldn't
in touch
produce
with all the owners.
it. Right.
It's perfect.
Yeah, yeah, yeah. So it was difficult for us. Yeah.
Awesome. So on the construction side, do you still bring in subcontractors, or are you literally trying to do everything from the ground up yourself?
Yeah. So, like I said, we're in North Dakota. I think we are, we can't get enough bids in per category,
Mhm.
excavating and the concrete and the frame, whatever. So, um, and sometimes you get a little gouging that comes up because of that. It's not as competitive a market. So, by doing that, we are bringing into the holding company, civil contract, dirt work guys and concrete. We have a big concrete team within Mac Construction, but Mac Concrete, and then, maybe some of the finished carpenters, just the categories that we find difficult to hire for and we lose a lot of margin on.
Mhm.
Um, there's difficulties when you hire a bunch of operating companies. You got to make sure the right people are in place before you go
Right.
about those. Um, but it gives us a competitive advantage for not only us, but our customers. We're doing about 50% in-house and 50% to our customers. So, we're not just working for, we're not just getting our own deals and doing our own deals. We're doing it for others as well. So,
Yeah.
yeah, I think it's a good difference between just if you're just developing right now, you're probably struggling.
Yeah,
You just can't get
for
enough deals
sure.
to go.
And
Yeah.
how are you juggling, so you're building got all these different trades. How are you keeping them all busy full time, or are you not?
Yeah. Again, I'm going to refer back to North Dakota because it is a little seasonal, right? We got about 170
Mhm.
days of uh, working days per year. So, approximately 2/3 of a normal year anywhere else because of winter. So, in the general contracting side, it's easy because things keep going. But your operations side, it's seasonally, or you lose margin because you're operating in cold weather. Things just
Mhm.
are more expensive.
Yeah.
We have a staff that oversees each company. Obviously we have one guy that operates the company, and then it filters up to like a holding company. So we give it, we have a team leading these guys as well. We don't leave them high and dry. We are very involved with every company, making sure they're performing at their highest and that we know what their needs are and how do we get them to increase volume, maybe, outside of just the development work. So, um, I think it's important to build that team, as you grow and especially as you have a development company, because you have that team up on top, you can really add in, our next one would be, say, something in materials. Maybe it's either buying a concrete company that produces, the deliverables for the concrete, or maybe a lumber yard saying, so we can get lumber at a cheaper price and do some of those things. So then we can pass the benefits off to our customers. Hopefully we get new customers because of that. And then hopefully our developments actually become more competitive, which is
Mhm.
an advantage to our LPs. So that's kind of how we see the world within, the verticals, right? And I think anyone vertically integrated, obviously it's an advantage for the customer or the investor.
Yeah.
So yeah.
So you're building self storage. You're building multifamily. Is that all that you're building right now?
Yeah, we've looked at some different product types. We found the most success though with honestly, we're doubling down on storage right now.
Hmm.
Um, we term it luxury storage. So if you ever seen me or heard of me, you probably deem me towards luxury storage, which is it's basically self storage. It's just a larger storage unit itself. So
Hmm.
picture instead of a 10 by 20, picture a 20 by 40 unit that's heated or cooled, depending upon your market, or both. And it has two lights and an outlet. No bathroom, but it has a big overhead door and a walk door. So we attract contract. I always thought it was going to be like boats and RVs that moved into these things. Well, it's like there's no boats and RVs in any of our models. It's really like small contractors that are looking for affordable space, small
Hmm.
business owners. You got a lot of flex industrial areas that industry, that type of space, flex space. Just it's crazy, and we're running 90% plus occupancy across that portfolio, just having larger units. And now we're starting to build models with a mix, of course, of these larger units and smaller units
Hmm.
involved, just because you can get more cost per square foot is kind of the storage game. So, but we're kind of deemed the luxury storage. So if you go on YouTube and type in luxury storage, my name will pop up, or Ryan Pineda,
Nice.
and kind of tell you what I'm building there, my business model.
That's
Yeah.
so cool. On the multifamily side, what size are you building? How many units
Yeah. So,
typically?
well, I've done a lot more. So far, what I've done is I've built affordable housing communities, build to rent type models that went into
Hmm.
townhomes, and then I ended up building out, say, like, I don't know if it was 60 or 70 units, whatever. We ended up keeping like 20, 30 of them. It
Hmm.
was like 22 of them exactly, and we turned them into kind of our first indication. We like, oh, we got done with this entire development, and it's like, yeah, some of them we ended up just renting them, and then we turned it into, we already had them. Some of the investors is like wanted to hold, and it's an easy investment because the utilities are paid by the tenants, and it was just like this build to rent model. So we ended up holding a bunch of those. I like the things, I don't necessarily just want to build apartments. I want to build things that I can, if we want to sell off six of those townhomes in 5 years, and then maybe we get all our equity back and we hold on to the other, you know, portion of them, 16 of them, then we would just do that. So I like the flexible space of the build to rent. So I've had a lot of luck within the like townhome models, affordable housing, but trying to build a product that people want to live in. Housing is just getting more dense, but anything that has flexibility of maybe I could sell it, maybe I could rent it, maybe I could lease it out, in any economy that will perform. So
Yeah.
I got burned back in the day with just building spec houses, just holding on to them, and it just wasn't a pleasant experience for me. And how do you rent out a $500,000 house? You really can't,
Right.
and it's
You
really
can't.
not worth it. And now today a $500,000 house is freaking, that's a regular house. It's
Yeah.
like it changed so much in the last 4 years. So we always stick to these townhome, whether fourplexes, investors in California will go and buy those, like from, what I
Mhm.
mean? Like they come up here to into the Midwest just to get fine margin.
Yeah.
So we kind of stick to that type of model, and we've had a lot of success with it. So we're just gonna keep going with that. It works in any economy, and it just reduced our risk as developers.
Yeah. What's
Um,
your cost per foot? And then what does your unit look like? Square footage wise, bed, baths, what's the sweet spot?
yeah. So this is going to be different. So in townhomes, you're going to see a lot of 3-bed, 2-bath type
Hmm.
layouts. These things are 1,400 to 1,800 square feet, depending upon the townhome layout. People like the attached garage. They like if it's heated. In our market, of course, because it's brutal winters. But in the multifamily space up here, I would say flipping to I'd say that'd be bread and butter for the townhomes. But if you and cost per square foot on those townhomes, I think we were building at like 160 a square
Okay.
foot, so it was decent.
Hmm.
Um, and then if we flip to multifamily, we're seeing units getting built in the 165 a unit up here, which is okay, I guess. I know in Florida they're about 195 to 300 depending upon what you're building.
Hmm.
Um, and we have seen more use. I think you just see apartment buildings getting smaller, like the units, like these efficiencies for 425 to 600 square feet. People are leasing those up to find affordable rent
Yeah.
in nice complexes. And so they like the amenities. They don't necessarily care about the living space. And so now we're starting to see a lot more of these efficiencies in one beds, um, that are almost treated like two beds, because I think two tenants are literally living in some of those. And then the 2-bed, 2 baths, that's really popular. Um, Not seeing a huge use for 3 beds and 2.5 bath. Like I think you got the baby boomers retiring, but like up here in our market, a lot of college, a lot of younger families, good job base.
Yeah.
So yeah, that's kind of what we see.
What kind of returns are your LPs getting?
Most of our deals we do 7 to 8% like a preferred on it.
Hmm.
I think if you're developing 3 years ago with cheaper interest rates, you could probably easily hit those at any point. Today, man, cash flow is the tightest thing, but we still obviously offer a preferred. Um, and I think we've been averaging 4, 5, 6, 7, just depending upon how far we are in the project,
Hmm.
on a cash return. But we're still seeing, and that's because we got a lot of capital in these deals. You're 65, 60% leveraged. It's hard to get a super high cash return off of that, but the IRRs, look really good if cap rates do stay kind of where they're at. I don't know that I see them going up a ton. Uh, More, maybe a little bit more, just as there's a little more pain in the market. But God, 3 years out, I don't see rates at 7%. I just don't. I
Yeah.
see them in mid fives. I see cap rates coming right back down with that at some point. I think if we underwrite things 5 years out in our market, I'm doing like a 6.5 to 7. up here, and obviously a lot different in the Sun Belt markets. So that's kind of what we see up here right now. Yeah. How about you? Where are you at?
I'm in Rochester, New York.
Okay, gotcha.
Yep.
Where are things at there?
They're all over the place. We're probably looking at you're purchasing at like 60 to 70% loan to value in order to
Yeah.
get some bank finance. Otherwise, the numbers just don't work. Most of the lenders up here are requiring 1.2.
Got it.
So, I think that there's room for some pricing to come down, but a lot of the sellers are just kind of like, hey, it's cash flowing for me now. I'm not really that motivated to sell it.
Yeah.
So I've gotten a lot of bigger transactions so close to the finish line, and then it's just like they don't end up coming together. The seller's like, no, I'm just not that motivated, and the buyer's like, well, I'm going to keep looking and hoping that prices come down. So it's kind of like a stalled market. Our volume
Yeah.
is maybe 25% of what it was a couple years ago
Mhm.
on the commercial
Sure.
side. So not a lot of inventory. There's still a lot of people that are hunting. I get calls every day of people that want to buy stuff, but it's just there's not much that makes sense to buy.
Right. Yeah. Right. Yeah. It doesn't make any sense on paper
Mhm.
right now. With pencils are definitely. I think you gotta get creative on getting people to the finish line at this point, and I've done quite a bit of that, just acquiring properties, which is not my main game, but I still acquire.
Mhm.
There's still some deals to be found out there as baby boomers retire. So
Yeah.
that's kind of what I find. What do you see with interest rates? What kind of spreads are they getting up there? Have you quoted anything recently?
Yeah, so they were as high as 8.35 about a week ago, commercial, about a week and a
Okay.
half ago. We're down to, I think, 7.85
Yeah.
yesterday, I believe. So that was good, so the underwriting's looking a little bit better for some people that are actually trying to make a deal happen. We're hoping that they keep going down. I mean, there's been some rumblings. I haven't really
Yeah.
researched it, but it sounds like what people are saying is that the Fed is going to pivot back to QE sooner than everybody thought.
Yeah.
So
I think
hopefully,
they'll have to. I don't know. Like you said,
yeah.
the banks are tight too. They're making sure their minimum DSCR, and without getting crazy with your rents, it's
Mhm.
kind of hard to
Yeah.
rents are going to continue to climb. I'll tell you that. This isn't going to make it any cheaper for
Oh,
anybody
no.
else.
No. Yep. I had
Rents.
one arm reset. That was painful. Probably at the worst possible time it could reset. I think it's around 8 or something stupid.
Okay.
And then I've got 2 more arms that come up. I don't think I have another one for like a year and a half, and then I have one in like 2 years. So hopefully things have like come down a bit from then because they're locked in at like incredibly low rates until then. Luckily, I found a credit union locally that would lend up to 1.5. That's like the max they would do on this product, but it was 15-year fixed commercial. So
Wow.
I took that amortized. I think I had to amortize it over either 15 or 20. So, I've definitely shrank my cash flow, but I locked myself into like a 4% loan on a
Oh, wow.
pretty hefty piece of real estate or several pieces of real estate. So I
Yeah.
feel like I protected myself luckily by the skin of my teeth because that was like literally before things started going through the roof. I'm doing my first major development project. I'm converting a 16,000 square foot old office building that's in our downtown core into 10 luxury apartments.
Oh,
And being my first development, I've learned a lot of lessons. One was that the phase one that the previous owner had, I still had to do a phase one, and I was like, oh, it's gonna be fine. Their phase one was fine. They had no problem redeveloping it when they did it back in the 80s. I think they did it mid
yep.
80s. So things have changed since then. They
Yeah.
were allowed to have these tanks underground and just fill them with water, like old fuel storage tanks. And they said, yeah, just fill them with water. You can put your parking lot over top of it. Today's day, no, you got to take the tank out. You got to test the
Oh,
water. And so I was at the mercy of this third party to get the tanks out, get the water tested, make sure everything was good before the bank would lock my rate. And so that process, I feel like it was like 2 months. It probably wasn't, but I just remember like every day seeing the rate go up and not being able to lock my loan and just like calling incessantly, like, guys, get the freaking water. Do I need to drive it somewhere? Can I give you somebody from my payroll to like
yeah.
expedite this? But I went, from where I was at the interest rate all the way up to like, I think I locked at like 7, which was so disappointing because the total project that meant that I just had to bring more equity to the table to do the project. Right. So I went from, needing, I basically doubled how much equity I needed to bring to the project
Yeah.
watch while that freaking phase one just blew up in my face. So just, little learning lessons like that. And,
Yeah.
working with the bank for the first time on a construction project where, I'm the borrower, I'm the developer, I'm the general contractor. That's been very interesting as well. It's,
Yeah,
they
it's
don't,
all in your
I'm
hands.
like, yeah, I'm like, well, I have to charge my fees for my construction services. Like my construction company can't work for free. They're like, yeah, no, we get that. But at the same time, they really don't want you to put that into the pro forma either. They don't
Oh,
want
right.
they want you to just eat it and be like, no, you just do that. It's not part of what we're lending you on. But I think we
Oh,
found a happy medium.
yeah.
There's a lot of things like that were disclosed up front seem to kind of evolve into other things as we've gone down this path. But they're being really reasonable as far as that goes. So I
Okay.
mean, yeah, it'll
Yeah.
get done. It's just my first one is lots of little speed bumps along the way.
Oh gosh. Yeah. My first one like 3 or 4 years ago was, trying to do like a 93 unit mixed use building.
Wow.
Small town. Yeah. So I took on like the Mount Everest for my first deal and got the equity together, got everything to the finish line. Took some time, took a lot of capital because you have to draft this entire thing, get it quoted, get it. We got a TIF. I don't know if you're familiar with some of those tax incentives from the city, which took 12 meetings. Took forever
Mhm.
because the town wasn't pro TIFs and support. So got all the way to the finish line, and then yeah, the equity ended up pivoting because rates started climbing. So they
Mhm.
pivoted into a REIT instead of this deal, and yeah, the deal ended up it's still nothing today, but nothing but a $750,000 that sank into a blank piece of dirt. Yeah,
Oh,
so it's just
jeez.
like, yeah, life got pretty tough as a developer when you do that. So still learning from that one, but that's the way it
Mhm.
goes.
Yeah, well, and just give us everything that we can use to avoid any problems. Like, I'm all ears. I'm sure people listening are all ears. That's the
Yeah,
one thing that you just can't. It's priceless when somebody's done something and they've figured out the hard way. If they can help somebody else avoid some of those things, like I've done so many stupid effing things. Like, uh,
yeah.
I'm with you.
Yeah, yeah. Well, you were probably new to the development game. You're like, all right, I got the contractor fee, and I gotta, you know, I haven't done a lot of work like this, so there's probably cost overruns. There's just things that you didn't think about, and more fees than you can had on the pro forma. And I think until you do some deals, you don't compensate yourself enough for that, right? Like
Yeah.
as a guy putting together deals, it's stressful enough, and then let alone you let in these capital investors. That's why I've now pivoted to me developing the deal, getting it off the ground, and
Hmm.
actually developing it where I'm like not reliant. That's why I pivoted to that model and just going a little bit smaller.
Hmm.
Um, and then back funding. So I'm not forced. I'm not pitching all these LP investors. It's like, do you want to be in the deal or not? Like, here's the deal. I pretty much took on all the risk.
Hmm.
You're able to invest beside me in a 3.5% loan if you want, and here's how it's performing. So, I think pivoting to that as a younger developer, which I'll call myself, instead of going for the behemoth project, putting all this capital, making everything, the pitch deck's legit, try to get all the PR right, get the investors right, and then not having the deal go through because you're reliant on other people. That's always the fear, right? So
Yeah.
try as a developer, I think you always got to have a capital source that's willing to sit beside you, and maybe you need to help them get in the deal or get some skin in the deal. So then maybe you can back fund it at a later time. I think that's the way a lot of developers are doing it nowadays, now that capital is tighter to find. So,
Yeah.
um, that's probably what I
And
would say.
I'd imagine that protects you a little bit more too than if you're taking it on the front end and not knowing exactly how much overhead you're going to have to do the project.
Right. Yeah. Yeah. It's intense in development, especially as you get bigger and w- today you got to have incentives from the cities to help you. Maybe you're an opportunity zone. Maybe you can get a TIF because you are bringing a special kind of project. Maybe luxury apartments, or maybe it's a boutique hotel in an area that needs stimulation. The cities are willing to incentivize you that, but it does take some effort and planning and meetings to get to that point. So even when you get to the finish line of that, I think more developers discredit themselves on not charging a fee enough for that type of service.
Yeah.
Again, why developers just don't charge enough in general. You only bake into the deal what you can get because you as a developer are now wanting to get the deal done, of course. So you're trying
Right.
to cut yourself down is really what ends up happening. And that's how I think a lot of developers don't end up continuing to develop. They're just like, I go acquire and then I do value add and then I refinance the deal and that's the way it goes. And because
Yeah.
they just didn't understand the development game. It's a much different route than just value add.
Yeah.
So
Do you track everything on the development side like really really closely as far as your not only just your hours? I mean, I should track my hours. I don't track any of my hours. That's just kind of like I doing that probably, but people that I have on staff to do a lot of that type of work, I track
yeah.
pretty well, and that's kind of how I base my development fee. Is that kind of how you do it, or you work on percentages, or how do you do that?
Yeah, I'd say I work on percentages. I don't track my time necessarily per development. Usually, the percentage that I'm charging as a development fee on development cost will usually dictate that. If I got to go and get a TIF, there's certain things that you can say like, I know I'm going to have this much. Now that I've experience in all that, I know how
Mhm.
long this stuff's going to take, and what it's going to really cost me. So I just adjust my percentage based on that.
Yeah.
So yeah, I development though, here's the thing with the development. Once you get the eye for development, it's like the entrepreneur in you that like, the grass is always greener in another world, or, you can get 20 deals going and none of them go. It's like, well,
Yeah.
you as a developer really have to start shedding off like, no, that isn't going to change the game here. No, I'm not going to do that. No, you have to
Yeah.
learn to say no because I've been in the I don't even know what you call it, just too many going on. You
Yeah.
have to know how to
Analyzing
track
and
them and prioritize them in
right.
order to get them done.
Yeah, which ones are gonna get done, and
Yeah.
so are you charging, like, 10% all hard soft? Is that, like, a typical development fee for you?
So I've always charged on hard cost. I haven't charged based on soft cost because that's a pretty minimal part. So I've always based it on hard costs. But in my hard costs, I do have land and I do have the construction and development fee. So I just charged. I don't charge 10%. I charge. It's based on really. I think it just depends on the size, right? Size and time
Mhm.
into it. If it's a real small project, say it's 2 or 3 million bucks or something, I would charge 8. I think if you're
Mhm.
under that, yeah, you're gonna charge probably 10. You're gonna have to just to get your time back out of the deal.
Yeah.
And then, the bank's going to want you to contribute that when you go to get lending. They're not going to want you to get that fee up front. They're going to want you maybe take it on the backside. Maybe they'll give you a little piece of it, 25%, maybe paid out monthly after that, like I've mentioned before.
Mhm.
Um, but yeah, and then the contractor fee usually go what's market or what's competitive in the market, I think, based on volume. So
Yeah.
just shrinks. Of course, you got $100 million project, you only need to charge 2.5%, right? Like it just really
Yeah.
depends, I think, for us.
So when your development company hires your construction company, are they working, like, at cost, or maybe not at maybe that's not the right word. Maybe, is there any markup that your construction company is charging to your developer or as the general contractor would? Or are you just hiring them at cost and kind of taking the GC portion onto the development side?
Well, I think it really depends how aggressive we need to be in the construction. Do we need the work? Do we want to get this to go? Of course, you start lowering your fees, right? And
Mhm.
if you're working with institutional investors, most of these guys would already know what I'm talking about. They predetermine everything, right? Like say Mac companies has all these different companies. Well, you're going to want to predetermine your contractor fee is going to be predetermined. Your developer fee is going to be predetermined. Your maybe what we get as a subcontractor through pouring the concrete, everything's going to be predetermined. I think if you can get to that point with like an investor or maybe a developer you're going to work for, maybe we don't even own it. And we're just doing the contracting side. I think the faster you can get to a predetermined trust and an open book policy, just like showing, hey, here's the bids we got at the lumber package. Our fee is 4%, 6%, whatever it is. I think the faster you can get to that point, you really build a lot of trust with customers and LPs, and it's open book, right? Like we're not hiding anything.
Mhm.
We have a project manager in here at a half 50%, and we have a full-time superintendent. That's it. Like,
Yeah.
we got to track this thing on Procore. So there's a little fee for that, right? So I think the faster you can get to predetermined things, like, and anyone that's listening to this has worked with institutional, they already know what, like, here's the rules we have, follow
Yeah.
them. Now if you're raising money yourself, now you can determine your own rules, right? Like, obviously
Yeah.
it's still got a pencil, but maybe could be more upside there for you.
Is there any conflict of interest there when you're raising money yourself, or is there a way that you handle that when you're working with your investors?
I don't think it's conflict of interest. I think we just make sure that we're competitive or more than competitive than the market because we have all these verticals.
Mhm.
Now, if you can't prove that you're more, if it's more money building it with you than and invest it, why would we do that? But
Yeah.
we are kind of a one-stop shop for them where they can dictate the construction. They can dictate, they can see every line item all the way, and in storage, we actually manage those. We just don't do multifamily.
Yeah.
So,
But wouldn't it be your job to get the multiple bids anyway? So it's like if you that's kind of where I was getting at. It's like, hey,
oh,
you've got the construction company,
yep.
you're competitive, but you're bringing in an investor, and from their perspective, to be like, hey, how do I know that this guy isn't just juicing the construction and doing all this other stuff if I don't know any better? And he's running the whole project through his different corporations.
Yeah, I think, it's always hard as a GC to go and bid it out because everyone's going to see it different. It really depends how the plans are written. But I
Mhm.
think if you can build what under market is building for, you can obviously see permit costs and different things and see, like, are you competitive in the market? Um, Usually you don't get any question. It's only if you're over,
Yeah.
if the market's buying units at 165,000 a unit and you're 200, um, ideally the deal's not going to pencil, and you're not even effective at being a vertical company.
Right.
So
Right.
but if we can produce them at 152 and they go in with a little equity, you know what I mean? So I think your appraisal is going to show that what the market's bringing. And if you can give them a little gap, the only reason to invest into a development company, into new units, is to get a spread on build costs versus, our yield on cost. Say we go in at 8-9%. Well, if our cap rate's 6, there's a pretty good yield there that when we refinance, when this thing's stabilized, there's a pretty good spread there between 8 and 5.5 that the bank is going to see it at.
Yeah.
So, I think if you show the investor that the yield on cost is way higher than the cap rate, even if it's 7 to 5, that's a huge difference. I mean, that, and I think most people listening to this knows that. But that's the only reason you would want to go into a development. You got to really show them that spread,
Mhm.
and make sure that you're competitive in the marketplace. And
Yeah. That
I
makes
don't
total
think you're
sense.
farming it out to 10 different GCs because they're all going to come back with different numbers. Because there's an entire value add play that we add, and value engineering, more or
Mhm.
less. Like, hey, we're not going to use these furnaces because they're $19,000. These ones are 6. They're quoted the
Mhm.
same. The warranty's the same. We're going to use these.
Yeah.
And so there's like all these value engineering steps that we go through in our construction, and we just show them that, right? Like if we're all open and transparent, it's like these plans get refined 5 times before we're moving forward. So,
Yeah.
um, and then, some of our vertical companies, the concrete and the civil contracting, it's like you just got to make sure we quote ourselves out just right next to the competition. So
Yeah.
we battle right next to them. So if we can show them that, then we tell them what our fee is in it, and again, predetermining everything I think is important as a developer.
What services do you provide under your civil contracting umbrella?
Just it's utility and dirt. So anything underground to get to 100, basically we can do that.
Then you
And
just
then
subcontract a really good architect.
yeah, so you got a civil engineer, whether good architect, good civil engineer
Mhm.
can get you what you need. And
But they're
as
not
far
on
as
your
on this,
payroll. You
no,
sub that
yeah,
out. Yeah. Yeah.
yeah, it's
That'd
it's
be
not worth
too
it.
many umbrellas.
Yeah, yeah. In a vertical company, you really wanna hone in on, what is the
Your
most
strengths.
problematic. There's lots of architects out there that are looking for work,
Yeah,
um, and you wanna
that's
create an
awesome.
alliance with them as a developer because you may find a big investor that's willing to come into your market, and, hey, maybe you can play ball right next to him and say, "Hey, this is all the stuff I got going on. We could probably be a one-stop shop for you or work beside you into this and maybe maybe do a joint venture or something."
Mhm. What does your
So
father think about all your success since, kind of watching you blow up like this?
yeah, he lives down in Arizona, and, he's like, "Gosh," the only thing he really tells me is like, "I wouldn't want your problems." So yeah. So his problems were the concrete truck wasn't on time, the guy didn't
Yeah.
show up for work,
Mhm.
and I always dictate people around me and I kinda read, and when I talk to people, I was like, "Wait, what's your biggest problem right now?" And I just see, you know I always like to see where people's problems are because I think it's like it kinda tells you, like, who they are, what the how big of it, like how big a thinker they really are. Like if your biggest problem is your dog's your neighbor's dog shit in your yard, well, we need bigger problems, right?
Yeah.
And so I can solve $100 problems all day, sit and solve every problem out there in the field. Or I can solve $1,000 problems, 100,000. I just that's how I quantitatively think about it. And I try to
Mhm.
surround myself with people that try to solve $1,000,000 problems, $10,000,000 and it's like,
Yeah.
I tell them my little problem of funding $3,000,000 and then they're like, "Phew, I'm funding 37,000,000." It's like, all right, that's a different level of problems.
Yeah.
And I always reflect at the end of the year too, what my problems were at the beginning of the year to the end. And it's
Mhm.
always funny how those change. So that's my way I reflect.
That's awesome. What does a
Yeah.
typical day in the life look like? What's your day to day, and how does
Yeah.
that I'd love to hear it.
Yeah, man. So I'm a big fitness guy. I try to stay in shape. And again, when I was back in that hospital, as a concrete guy, I was on the contractor kick with 3 monsters and 4 coffees every day, and not the healthiest, but needed a lot of energy at all times. So that wound me up in the hospital. But what and I had a bad back. Okay, and I was doing concrete work, so I mean that may come into play, but um, I just had a weak core and just didn't take care of myself and probably aged my body a lot till 27. And,
Mhm.
got into fitness, no more back problems, no more anxiety, no more, uh, no more. I just get more energy just from doing that, I think. And so, big health guy. And I think for my mindset and,
Yeah.
and wellness. And now I got to be there for my family. So it's like, I love it. So I'm big on the health side. So that's every morning. And then I do jump on LinkedIn for a while. I write down 3 things I'm grateful for and 3 things that like are my big, hairy, audacious goals for the future.
Mhm.
I try to write that every morning. Just more reflection, and then I jump on LinkedIn and try to network. I just find a lot of value from different people on LinkedIn and even some of these different social platforms. I've met a lot of very cool people around the states. So and then by 10 a.m. I'm locked into developing or self-branding. I spend a lot of time in development. That's probably
Yeah.
70% of my week. And I spend about 5% within my construction company. So very little time. Everything is
That's good.
hired out there. They have a great team.
Mhm.
And then I probably spend 5% trying to build a vertical company or trying to grow it and whatever. So, and then I spend some time branding, probably just self-promoting, branding, doing what we're doing on here, trying to help people, coaching, some things that I never even thought I would ever do 2 years ago. Try to help people who are interested with some of my knowledge and want to get here. If they see me a couple years in front of them, then I do some mentoring and coaching, usually just a few students at a time. I get a lot of satisfaction from it and it, I think it changes their life. I do it for like 10 weeks and it does help them quite a bit. So if you are into coaching, I do a little bit of that. You can reach out to me.
Nice.
Um, yeah, and I just like helping people too at this point. It's something
I might be hitting you up for some coaching, man.
yeah, yeah, yeah. Well, yeah,
I
real
could go
estate
on for
development, it's a
hours with
thick
these
one. Yeah.
questions, like, it's just never-ending flow. Who are
Yeah.
you we still got, like, 6 minutes until the hour, like, who are your key personnel? And, So I think like even in my small company, one of the things that I would like to improve, because I'm like you, like I will dive into development like 70% of the time or whatever. But then it's like, okay, the people that you have for your KP, your key people personnel, you got to have a lot of trust in them. Like what is their backgrounds? What are their what is the ownership like? And not like as far as like monetary, but I don't know, maybe just talk a little bit about that. I'm curious.
So all the vertical companies you're asking and like kind of how the key members play a
How
role?
can you give yourself 70% to just say, "Hey, I worked out, I did my stuff that, that's not you're not really checking on anybody, right?"
Yep. Yeah.
H
And
How is
so
that all operating without you checking on them, I guess?
yeah, so again, another reason I ended up in the hospital was that I was doing everything, right?
Yeah, yeah.
And probably not living a healthy lifestyle. But I I I got curious about this as well. So once I got curious about real estate, developing, it just added more things. Now I wasn't this concrete guy. I was doing construction and general contracting and developing. It was like, wow, I'm only good at so many things.
Mhm,
And so I started hiring for things I was weak at. I just realized, like, wrote down like, here's my weakness. Like, I'm not analytical. I don't like to sit and do spreadsheets. Okay. Find the estimator then that likes to do construction and real, performance, whatever it is. Hire those guys first. And then I just kind of kept doing that from like 2017 to now.
mhm,
But then I realized also I was at all these meetings. I had like 14 meetings. It's like everything was a meeting. It was like I was meetinged out. So in 2020, kind of during right down to in the pandemic, I hired a business coach that implemented EOS, Entrepreneurial Operating System. So the book Traction by Gino Wickman, if you haven't read it, good
mhm,
for a business that's growing, can run a coffee shop or $1 billion company. Um, and just kind of fell in love with the platform and just tells you how to make goals every 90 days and really get your business to perform without you there.
mhm,
And create this leadership team that really operates things almost as a board and runs the business as it should be. Each person is accountable for one area. You got marketing, sales,
mhm.
operations, whatever it is in your company, accounting. Um, Create one person, one head to chop, right? Like we had too many lines drawn to too many people. It's like, well, I sometimes do that, but then I sometimes do this. So it really makes things black and white and a straight arrow to everything. And if there's too many names in a box, like if I do the accounting, the sales, and the then you have a problem. You're the chokehold.
Yeah, yeah.
And so EOS gets you to identify that, and then gets you to just to operate as a board, like where I could be gone for 6 months and, we're still selling things. I'm not, usually as the owner, the guy, like, just like you, Mark, you're probably out there finding the deals and getting every deal and getting it to the finish line with financing. And, you know, um, as you keep growing though, you're not gonna be able to do that. You're going to drive yourself crazy. So, every year we identify bottlenecks, and try to hire within that, um, in that regard, but as a board, not as just Mark,
Mhm,
but,
yeah,
so I think EOS helped me tremendously within each business. And I've helped many companies. Just, you can go inside any company and there's problems, right? Like no one's a perfect
yeah.
star.
So I'd
um,
imagine that you're getting a bunch of good metrics then, right,
yeah.
out of this system that you built. I'm still going through Traction right now and starting
Okay.
at implementing it. So I'll definitely finish it during this break before the new year.
Yeah.
What metrics are your people giving you so you can kind of keep an eye on things, make sure that your overhead is not only just covered but you're profitable? Like, what are those metrics? Because my problem is like when there's so many different companies going on, I like to keep everything compartmentalized. Like, I want to be able to look at
Yep.
my management company, I want to be able to look at my brokerage, I want to be able to look
Yep.
at my development company, and it's just tough. It's
Yeah.
tough.
Yeah, so you should be performing, EOS within all those. And so what EOS would be there's L10 meetings. So that management group should have one, two, three heads, whatever it is. If you need to be there, great, but you don't want to meeting yourself out either.
Mhm.
You can have a person like these bigger companies that have like 10 holding companies. They have like a guy that sits in a meeting for me, you know what I mean? And like he just
Mhm.
reports a summary and sends it back. Um,
Okay.
but yeah, you have a dashboard like within this L10. So this L10 is the meeting. you'd have a dashboard, which is the scorecard. It dictates, okay, hey, management team, what's the 4 metrics, right? What's the 4 KPIs? What really matters? Okay, maybe it's how many move outs, how many move ins, right? Okay, net
Mhm.
plus 1 move in. Okay, every week, this is every week, right? So this is what you need to know weekly. Okay, what what was our margins operating last week? What's our accounts receivable sitting at? Whatever the important things are.
Mhm.
And sometimes that can be the hardest part. I think within construction, it's probably the hardest for KPIs, but management companies, you can literally Google this and come down to a dashboard. You can get that report card sent to you every night, Mark, if you like looking at it before you go to bed. I mean,
Mhm.
I have my assistant send me 3 scorecards every night. I mean, my marketing department, my assistant, and then my general manager of the construction. They all send me a report card daily. Now, that may seem unreasonable to some,
Mhm.
but Grant Cardone gets his financials put in front of him every hour, it's like only as reasonable as you want. If you want to know, just tell your people to do it,
Mhm.
and do that. I think that gives me a good grasp on each and every area of my business. But literally, these L10s, so important to have because that should bring up the dashboard. Everyone sees the writing on the wall, like good, bad, or the ugly. We should know from those metrics to pivot within a week. You don't want to wait a quarter. You don't want to wait a year. You don't want to even
Right.
wait a month. You want to wait weekly. So your weekly stuff should give you your monthly financials. Basically, you should already know what's coming, right?
Mhm.
And be able to pivot quickly. I think companies that see things, I mean, there's contractors that view things as annual, quarterly, monthly, even I think is too late. I want to know at least weekly what's going on. Are
Yeah.
we winning? Are we losing on the scorecard?
Yeah.
Um, so I think that's super important to me. And, you know, I think that'll help you a little bit understand, it's like playing hockey without a score, or we'd say things like North Dakota hockey, but,
Mhm.
playing without a scoreboard, it's like, how do you know what the freaking score is if you're not
Right.
keeping it? No one
Yeah.
knows how to get better. It's like, okay, my metrics have been the same and we're still here. Like we need to
Yeah.
get better.
Yep.
And so we, in the social media world, I've been doing that, it's like, followers only been here, well, impressions, and that's just some of your inputs, but what's the outputs? You have leading indicators, so things that your inputs, and then you have financials, outputs. Usually people see everything as financial as the lagging indicator,
Yeah.
but no one looks at the inputs. They just look at the lagging indicator and then try to pivot after 2 months go by
Right.
and you get the financial report. So it's just simple things that you can learn within EOS and building a scorecard. The book, The Road Less Stupid, is a very good one by Keith Cunningham. Literally, it's an older book, but man, he runs like his mindset is like EOS.
Mhm.
Nothing to do with EOS, but a very good book and a very good coach on the stuff we're talking about.
Yeah. The EOS is from Traction.
Yeah,
The ro
Gino. Yeah,
Yep. And
read
then The
that.
Road Less Stupid, I'll pull that one up. The first one
Yeah,
I read was The E-Myth, and that was the first big shift for me to get into this, like, you
yeah.
know, sorting things out and not being so I could feel like I could do 70% development and not have to, like, run around and micro everything that was happening.
Yeah, yeah, when you feel that way, it feels almost like quicksand, it just feels like it consumes you, and it's like, I don't wanna feel like that with any, and of course, it takes margin to do that, right? Like, you do all those things because you don't wanna hire that person at the end of the day, or they're not being
Yeah.
directed right, or you're not holding them accountable. It's really a few things there. So, if you can hold them accountable, which is a whole 'nother topic, is challenging, but getting those reports would be holding them accountable, watching their
Right.
metrics suck, and they gotta send them to you,
Yeah.
then the writing's on the table, and they already know the problem.
Yeah.
It's like, so, but yeah, The Road Less Stupid is a good one. Keith
Awesome. Well,
Cunningham's
I
a good
mean,
guy.
this has been fantastic. We've crushed the hour. I definitely want to
Yeah,
get you back on for round two if you're game. I mean,
yeah,
there's so
let's do
many
it.
things that I didn't get to talk on because, like, I'm obsessed with development, and it was just a really good fit to have you on here, especially for
Yeah,
where I'm at in my journey.
cool.
Is there anything that you want to tell the audience before we go? How they can reach out and get in touch with you? I'll definitely be hooking up with you about your coaching program for sure.
Yeah, yeah, if you're interested, I guess the only couple products I offer is for the beginning guys out there. I have a real estate course. It touches on development, touches on how to do your own real estate deal. You can DM me if you hear this, you DM me the word course. No matter what social platform on, I'll send you a coupon code to get that, and you can gift it to somebody, whatever. And then yeah, we have a wait list for the coaching. Like I said, I only do a few students at a time,
Yeah.
just because my time is precious to me, and but I do love helping people. I just, it does cost something for the coaching, of course. And you can reach out to me, just put the word coach or something, and we'll reach out to you and see where you would fit in. Yeah, follow me on the social platforms, YouTube, LinkedIn. I'm pretty much everywhere. Instagram, no matter where, I try to provide some value where I go.
Awesome. Well, thank you so much for coming on the show, and hopefully we can get you back on here real soon.
Yeah, Mark, I appreciate it, man.
Yeah. Thanks so much.
Yeah, see you, buddy.